A company reports a 44% drop in profit. The headline looks terrible. But look at the bottom of this slide. Gross margin, 40.7%, a record high. Operating cash flow, $18.7 million, also a record high. Dividend yield sitting at 4.7%, and management kept the dividend unchanged. So what's actually going on here? Today I'm doing a full deep dive on Hyphens Pharma, SGX ticker 1J5. I've spent the last few days going through 6 years of annual reports, line by line. This is not a buy recommendation. By the end of this video, you'll understand exactly how this business makes money, where the real risks are, what it might actually be worth, and whether this is something worth paying attention to. Let's go. So here's the setup. FI 2025 net profit, down 44%. That's the number that got attention. That's the number that spooked a lot of people. But look at these other two numbers sitting right next to it. Gross margin, 40.7%. That is the best gross margin this company has ever reported. In any year, ever. Operating cash flow, 18.7 million Singapore dollars. Also a record, the highest in the company's history. How does a company's profit fall 44% in the same year it posts record margins and record cash flow? That's what I wanted to understand. And the answer, which I'll show you in a few minutes, is that almost all of that profit drop came from one-off charges that had nothing to do with the core business. The underlying business? Intact. Actually better than it was the year before. The italic line at the bottom of the slide says it clearly. The one-off losses that crushed the headline profit were foreign exchange, an inventory write-off, and a bad debt provision. None of those are structural. That's the whole thesis in one slide. Now let me prove it. First, let's understand what Hyphens actually does. Because when I first looked at this company, I thought it was just a pharma distributor, a middleman, and it is partly, but there's more to it. 3 segments. Let me walk through each one. Segment 1 on the left, specialty pharma and medical aesthetics. 57% of revenue. This is the core and oldest part of the business. What Hyphens does here is act as the exclusive ASEAN distributor for pharmaceutical and aesthetic products made by companies in Europe, the US, and Japan. Think about it from the pharma company's perspective. A company in France develops a specialized drug. They don't want to deal with the complexity of registering it in Singapore, then Malaysia, then Vietnam, then Indonesia, then the Philippines, 6 different regulatory bodies, 6 different healthcare systems. So they partner with Hyphens. Hyphens gets exclusive rights. They import it, get it registered, market it to doctors, and sell it through hospitals and clinics. Products include CuroSurf. That's a life-saving drug for premature babies who can't breathe properly. Doterem, an MRI contrast agent. Sterimar nasal health. And most recently, they're building an aesthetics arm called Ardence, selling injectables like hyaluronic acid fillers to clinics. Hyphens earns the margin between what they pay the supplier and what they sell for locally. They don't manufacture anything. Segment 2, proprietary brands. 21% of revenue. And this is the most interesting part. These are products where Hyphens owns the intellectual property or holds exclusive rights. Ceradan, a ceramide-based emollient for eczema with a patented formula. Ocean Health, health supplements, a trusted household name in Singapore. CG210, a scalp care line, also patented. And Winlevi, a new acne treatment where they have exclusive rights across all 10 Southeast Asian countries. I'll say more about Winlevi later. But notice the badge on this card. Up 33% in a year where total company revenue fell. This is where the growth is. This is what management is building towards. Segment 3, digital platform and e-pharmacy. 22% of revenue. This is DocMed Technology, their digital arm. They run an online B2B marketplace for healthcare professionals. PLM in Singapore, Pharmacy in Malaysia. Over 25,000 registered healthcare providers. They also run Wellaway, which is Singapore's first HS-registered e-pharmacy, handling e-prescriptions and home medication delivery. This segment is early stage. It's not generating meaningful profit yet, but the strategic logic is sound, and I'll come back to it. So 3 businesses, 3 different margin profiles, 3 different growth rates. Keep that in mind as we look at the numbers. Let's look at the numbers now. Revenue, FI 2020, 124 million Singapore dollars. Grew steadily to a peak of 195 million Singapore dollars in FI 2024. That's a 5-year CAGR of about 9.5%. Solid, consistent growth. Then FI 2025, the red bar on the right, revenue drops to 177 million Singapore dollars. The annotation on the slide explains exactly why. Vietnam regulatory headwinds and a product reclassification. Vietnam alone dropped from 57 million Singapore dollars in FI 2023 to 40 million Singapore dollars in FI 2025. The Vietnamese Ministry of Health tightened pharmaceutical distribution rules, stricter good pharmacy practice standards, tighter product registration. It disrupted Hyphens' entire distribution network in country. 17 million Singapore dollars in revenue, gone in 2 years. And reclassification. Some products that were previously counted in specialty pharma were moved into the proprietary brand segment. That shifts numbers between columns but doesn't change total revenue. So the revenue decline is real, but the cause is specific. It's Vietnam, and it's a reclassification, not broad business deterioration. Now here's the slide that tells a real story. Gross margin, FI 2020, 35.4%. Stays roughly in the 36 to 39% range for the next 4 years. Then FI 2025, up to 40.7%, a 530 basis point improvement in a year when revenue fell. Look at the shape of that line. It doesn't gradually drift upward year by year. It jumps in FI 2025, and that jump happened precisely because of the product mix shift I just described. When Vietnam revenue fell, that's lower margin distribution revenue. When proprietary brands grew 33%, those are higher margin IP-backed products. The mix shifted toward better margin products, and the gross profit line reflects that. The call out at the bottom of the slide, FI 2025 40.7% is an all-time high. FI 2020 was 35.4%. That's more than 5 percentage points of gross margin improvement over 5 years. That doesn't happen by accident. Management has been deliberately moving the portfolio toward higher margin products. And FI 2025 is the clearest evidence that it's working. So if gross profit is at a record high, why did net profit drop 44%? This is the key slide. 3 boxes, 3 charges that showed up in other losses in FI 2025. First box, FXlosses, 2.8 million Singapore dollars. Hyphens buys products from European suppliers, priced in euros, but they collect revenue in Vietnamese dong, Indonesian rupiah, Philippine peso, Malaysian ringgit. When the euro strengthens against those currencies, as it did in 2025, the cost of procurement goes up and the margin gets squeezed. That's a pure currency mismatch. 2.8 million Singapore dollars in FX losses that year. Second box, inventory write-off, 3.9 million Singapore dollars. This one is a management error. Honestly, in FI 2023, there was a Sterimar stockout, they ran out of product and missed sales. So in FI 2024, they overcorrected and built up a lot of inventory. Then market conditions changed, demand didn't absorb it, and in FI 2025, they wrote off the excess. One-time charge. The stock is now cleared. Third box, bad debt provision, 0.6 million Singapore dollars. A loan they extended to their Vietnam digital platform, VietPOM. Vietnam adoption has been slower than expected, so they provisioned against it. Small number, but a signal worth watching on the Vietnam front. Add those 3 up, 7.6 million Singapore dollars in other losses. Now look at the 2 banners at the bottom of the slide. Strip those out, normalized profit is approximately 11 to 12 million Singapore dollars. Roughly flat with FI 2024's 10.9 million Singapore dollars. The underlying earnings power of the business has not deteriorated. And operating cash flow, 18.7 million Singapore dollars. Record high. The cash is real. The business is generating it. Balance sheet. 4 numbers at the top tell the story quickly. Cash, 26.8 million Singapore dollars. Bank debt, 7.5 million Singapore dollars. Net cash position, 19.3 million Singapore dollars. This is a company with no leverage problem. 0. The balance sheet is clean. And the dividend yield, 4.7% at the current price. Now look at the dividend history table below. FI 2019, 0.62 cents per share. FI 2022, 1.11 cents. FI 2025 proposed, 1.50 cents. That's a consistent upward trend since IPO, excluding the FI 2023 special dividend. That 4.46 cents number includes a 3.60 cents one-off for the company's IPO 5th anniversary. The regular dividend has been growing. And the most important point, management maintained the dividend at 1.50 cents in FI 2025, despite reported profit falling 44%. That is a deliberate signal. They're saying, we know the reported number this year is distorted. The business is fine. We're keeping the dividend. The green call out at the bottom, FCF payout ratio, is 24.6%. That's dividends paid of 4.6 million Singapore dollars against operating cash flow of 18.7 million Singapore dollars. The dividend is very safe on a cash flow basis. So is this a good business? What actually gives Hyphens its edge? For moats, I've rated each one. Top left, regulatory expertise. 4 out of 5. This is the strongest and most underrated moat. 27 years navigating the regulatory bodies of every major ASEAN market. Singapore's HSA, Indonesia's BPOM, Vietnam's Ministry of Health, Philippines' FDA, Malaysia's NPRA. Getting a drug registered in a single country takes 1 to 3 years. Their head of regulatory affairs has been with the company since 1997, 28 years. You cannot buy that knowledge overnight. A pharmaceutical company in Europe that wants to sell into 6 ASEAN markets has 2 choices: build their own regulatory team in each country or partner with Hyphens. For most of them, Hyphens is cheaper, faster, and lower risk. That's the core commercial rationale. Top right, exclusive agreements. 3 out of 5. Each exclusive distribution contract is a product-specific moat. CuraSurf has been with Hyphens for over 25 years. Doterem, long-term. And in October 2025, Medac GmbH extended the Medact agreement, which was originally for 4 countries, to also cover Thailand and Cambodia. That's a principle choosing to deepen the relationship. These renewals aren't guaranteed, but the track record is strong. Bottom left, proprietary brand IP. 3 out of 5. Ceradan ceramide formula is patented. CG210 is patented. Winlevi, exclusive ASEAN rights from Cosmo Pharmaceuticals. This IP-backed revenue is 21% of total today and growing at 33% per year. Over time, this is what reduces dependence on distribution agreements. Bottom right, Pamelayan Network. 3 out of 5. Pamelayan Pharmaceuticals has served Singapore's pharma market since the 1940s. 80 years of relationships. 25,000 healthcare professionals on their digital platforms. Clinical trust built over decades. That doesn't disappear. Overall, a media moat business. Strongest in regulatory expertise. The proprietary brands piece is where the long-term value creation will come from. Now the risks, and I want to be direct here. There are real ones. Vietnam, high risk. You can see it in the numbers. 57 million Singapore dollars in FI 2023, down to 40 million Singapore dollars in FI 2025. That is 17 million Singapore dollar revenue drop in 2 years from a single market. The Vietnamese Ministry of Health tightened GBP standards. Hyphens' distribution network was disrupted. Management is rebuilding. But they're also saying explicitly that 2026 remains challenging. This is the single biggest overhang on the stock. Until Vietnam stabilizes, there will always be uncertainty hanging over the numbers. FX exposure, medium risk, buys in euros, collects in local ASEAN currencies. No robust hedging program. This is a structural vulnerability. In a year where the euro strengthens, margins get hit. We saw it clearly in FI 2025. It needs to be managed better. Low free float, medium risk, Only 23.7% of shares are publicly tradable. The founder and co-founder together own 76%. This means wide bid-ask spreads, thin trading volume. If you're a private investor trying to build a meaningful position, anything above about 100,000 Singapore dollars to 150,000 Singapore dollars, you will move the price. That's part of why institutional investors haven't piled in, and part of why the stock may trade below intrinsic value. Principal risk, medium risk. If a large pharmaceutical company decides their ASEAN business is now big enough to justify building their own commercial team, Hyphens loses that agreement. It doesn't happen overnight, but it's the structural risk that every specialty distributor faces. The proprietary brand strategy is the hedge against this. Key person risk. Low. The head of regulatory affairs has been with the company for 28 years. If she leaves, filling that gap takes years. Succession planning is not clearly disclosed. Worth knowing. Now, let's put a number on this. Where does Hyphens trade relative to comparable companies? Look at the amber row. That's Hyphens. The numbers underneath are normalized, stripping out the 7.6 million Singapore dollars one-off losses. So we're comparing like for like. EV/sales, 0.52 times. Peers are between 0.3 and 2.4 times. Peer median is 0.9 times. Hyphens is at a 42% discount. EV/EBIT normalized, approximately 5 times. Peer median is 13 times. Hyphens is at a 62% discount. Normalized PE, approximately 8 times. Peer median is 17 times. 53% discount. Dividend yield, 4.7%. Peer median, 3.1%. Hyphens is more generous. Now, is some discount justified? Yes. Low free float. Vietnam uncertainty. Catalyst listing rather than main board. These are real reasons for a liquidity discount. But 50 to 60% below peer multiples? That gap is wide. The question is whether that discount represents a permanent structural impairment or a temporary, resolvable set of headwinds that the market is treating as permanent. I think it's the latter. But you decide. Let me put a fair value number on it. Left panel, my assumptions. Owner earnings base of approximately 12 million Singapore dollars. That's normalized profit plus depreciation minus maintenance capex. Stripping out the one-off losses. Growth of 10% per year for years 1 to 5 in the base case, 5% in the bear case, slowing to 6%, then 3% in years 6 to 10. Terminal growth at 2.5%. That's long-run ASEAN nominal GDP. Discount rate of 11.5% in the base case, which already includes a premium for the EM exposure and the illiquidity of the stock. Right panel, the output, base case intrinsic value, 0.657 Singapore dollars per share. Bear case, 0.410 Singapore dollars. Current price, 0.320 Singapore dollars. Margin of safety against the base midpoint, 52%. Even against the bear case, the stock looks fair to slightly cheap at current prices. I also ran a multiples base valuation applying sector median EV/EBIT to normalized earnings. That gives a similar answer, around 68 cents per share. The two methods agree. That's what you want to see. The blended fair value, approximately 0.671 Singapore dollars per share. Current price is 0.320 Singapore dollars. That's a 52% discount. Now, let me flip the question. Instead of asking what the business is worth, let me ask, what does the market have to believe for 32 cents to be the right price? 3 things. All 3 have to be permanently true. First, zero earnings recovery. The market is assuming that 7.6 million Singapore dollars in one-off losses, FX, inventory write-off, bad debt, happens every single year, permanently, not a one-time hit. A recurring annual feature of this business. Second, Vietnam never recovers. The market is treating that 17 million Singapore dollar revenue gap as a permanent structural impairment, not a temporary regulatory headwind that management is actively working to fix. Gone forever. Third, no growth initiative works. Winlevi, the first new class of acne drug in 40 years, with exclusive rights across all 10 ASEAN countries. Mediject, a new rheumatoid arthritis product with 6-country coverage. Ardent Aesthetics expanding into Malaysia, Indonesia, the Philippines. POM 5.0 and AI-powered digital tools. Serapro MED being licensed into 6 European countries. All of that priced at zero. That's what buying at current prices implies. You don't need to believe. You just need the one-off losses to normalize. That's the minimum scenario for the current price to be wrong. The teal bar at the bottom says it. At 0.320 Singapore dollars, you only need the non-recurring losses to normalize to generate a strong return. That's a low bar. Here's my EPS forecast through to FI 2030. FI 2025 actual, 1.89 cents. That's the red bar. That's the distorted year. FI 2026 estimated, 4.22 cents. That's a jump of 123% on paper. But most of it is just a normalization of those one-off losses. When you strip the 7.6 million Singapore dollars in write-offs from FI 2025 and assume they don't repeat, you get a clean step up in earnings. This is not me projecting exceptional growth. This is me saying the non-recurring stuff stops recurring. From FI 2027 onwards, 5.31, 6.53, 7.75, then 9.11 cents by FI 2030. That's driven by proprietary brand mix expansion. When Levi roll out across ASEAN, Mediject geographic expansion into Philippines and Indonesia, and digital platform monetization. Bear case. If Vietnam stays depressed and FX headwind persists, FI 2026 might only be 2.5 to 3 cents. Growth would still come, just more slowly. The important caveat at the bottom, these are my independent estimates, not company guidance. The single biggest swing factor is whether those one-off losses normalize in FI 2026. That's the number to watch. All right, final slide before the outro. Left column, what I like. The business is better than the headline numbers suggest. Record gross margin. Record operating cash flow. Net cash balance sheet. The founder owns 47.8%. He is completely aligned with shareholders because he is one of the largest shareholders. Real pipeline of catalysts in Levi, Mediject, Ardent Aesthetics, and a 52% discount to blended intrinsic value. Right column, what I'm watching. Vietnam, that is the key overhang, and the recovery timeline is genuinely uncertain. FX mismatch, structural problem, not enough being done to hedge it, low free float. This limits how much any individual investor can realistically build. No clear short-term re-rating catalyst, unless there's a main board transfer announcement or a Vietnam recovery faster than expected. And goodwill impairment risk. There's 24 million Singapore dollars of intangibles on the balance sheet from acquisitions. If Vietnam or the digital platform disappoints significantly, that could be written down. The verdict bar at the bottom. Watch. Ideal entry around 28 cents. At 32 cents, the risk-reward is attractive on paper, but the illiquidity means you have to be disciplined about position sizing and patient about entry. This is not a stock for everyone. If you need liquidity, if you need a short-term catalyst, if you can't stomach watching Vietnam numbers for another year, it's probably not for you. But if you're patient, comfortable with small caps, and can hold through noise, this is the kind of setup value investors look for. That's the full breakdown. Full research report. 6 years of analysis, including the supply chain map, forensic accounting section, all 15 CEO questions, and a complete DCF, is linked in the description. Free. To download. If this was useful, subscribe. I do these deep dives regularly. No hype, no tips, just honest analysis. And if you already own this stock, or you've looked at it before, drop a comment. I read every one. Especially interested to hear from anyone who has a view on the Vietnam situation. See you in the next one.